Hey everybody, my name is Justin. Today I want to do a stock analysis on Sprouts Farmers Market, ticker symbol SFM. I think this is a small stock that will have big returns going out into the future. This is a stock I personally own. So I want to do a stock analysis on this company that will go over the management team. We're going to go over what this company does, what sets them apart from their competition, so their competitive advantage or their moat. We're going to talk about risk associated with this company. We're also going to talk about valuation, intrinsic value for this company, and the expected return on investment I expect to make on this stock based on growth rates going out into the future. So I hope you get some value out of this video, and you'll get to see how I evaluate companies and what my process is. So let's first talk about the stock price and look at a 5-year chart, because this can be extremely deceiving. So if you look back 5 years, the stock was roughly around $21, $22. Today it's at $22. The stock literally has gone up only 4% over 5 years. So I think a lot of people look at this chart and say, wow, why in the world would I ever want to buy into Sprouts? They're pretty much flat over that period of time, and it doesn't look like a very good stock to be in. And their high was about $30 a share back in 2018. Last year they dropped all the way down to $13 a share. But this chart is very deceiving in my opinion, and you'll see why as we get through this video. All right, so now let's talk about the business overview for Sprouts. They are an American grocery store chain. They focus on produce, which constitutes about 22% of their sales. My wife and I shop at Sprouts every single week. In fact, the reason why we go there is because of their produce. They sell a lot of other organic items as well. They sell meats like chicken and beef. They're mostly concentrated in California. So they have about 362 stores at the end of last year. Now, as of this past quarter, they have about 363 stores. So they only added one store in the first 6 months, but they're adding more in the back half of this year. So a third of their stores are in California, and the rest are kind of spread out kind of in the southern region of the United States, and they are also located in Washington as well. The firm sells roughly 20,000 products, which are about 25% organic, with private labeling that account for about 16% of their sales. They also have perishable items that accounted for 57% of their fiscal 2020 sales. And this was all pulled from their 10K. What's really cool about this company, it sets them apart from other grocery store chains, is they partner with local and regional farmers. So here in Colorado, a lot of times when I go in to buy corn during the summer, they actually got their corn from local Colorado farmers. So depending where you're at, what state you're at, where you're shopping for Sprouts, there's a good chance that the produce that you're buying, they actually got in that same state or the surrounding states. So now let's talk about goals that this company has, this management has going out. And this is extremely important. I think this is what is going to change this company going out to the future. So first off, they're working on cost reduction. And one of those items is marketing. So back in early 2020, they stopped printing ads. So they used to send out ads every single month. I even got those as well. What they were finding is that these deal hunters would see what the sales were. They go to the store just for the sales, buy those, and buy nothing else. And a lot of times these sales are loss leaders. So I worked at PetSmart in high school and in college, and they also had loss leaders. So you buy Pedigree dog food, Purina dog food, they actually lose money in every single bag that they sell. But the idea is they get people in to buy that food, but they'll buy dog toys, they'll buy shampoo for their dogs, they'll buy other items which will make up for that and get those people in the store to get that food. And so they were finding out they're actually losing money from these people coming in just to buy the stuff that was on sale. In August of this year, they released a new brand campaign called Sprouts Where Goodness Grows, and they launched their first ever TV commercial. Another cost reduction that they're focusing on is stores. So right now, their footprints of their store are over 30,000 square feet. And now they're going to be putting in new, smaller stores, less than 25,000 square feet, which will reduce their cost by 20%. And they did some testing this year. In fact, they redid one of their stores, and just to kind of test to see how well it's doing. And from the last earnings call, Customers are very happy with the footprint that's going on, and so it looks like this will be a very, very good advantage for this company going forward by reducing costs, but also they believe that they'll keep the same amount of sales per store, even though they're reducing that footprint. Another thing to talk about is growth. This company is a very high growth company. They plan to open about 20 new stores this year, mostly in the back half of 2021. And then going forward, their annual growth is expected to be about 10% or more per year. They're opening up 2 new distribution centers this year. In fact, they opened up one in my hometown of Aurora, Colorado, just a few months ago. 85% of their stores are within 250 miles of a distribution center. And right now, with the distribution centers they have in place, those would be able to accommodate 500 to 600 stores across the nation. So they could literally grow another 150 stores before actually maxing out their distribution centers from there. They're also working on improving shareholder value. Last year, they announced a $300 million buyback program. Keep in mind, this company is a $2.5 billion company, so they're buying back more than 10% of the company to increase earnings per share, which is fantastic. So they're headquartered in Phoenix, Arizona. They were founded in 2002. They have 363 stores in 23 different states as of this past quarter, $2.5 billion market cap, 33,000 employees. They did about $6 billion in revenue. And typically when I see a $2.5 billion market cap in most industries, I would expect the revenue to be between $1 billion and $2.5 billion. So $6 billion is a lot, but that's not too unexpected for grocery store chains or even retail, just because margins are pretty small, which we'll talk about here in a little bit. Their PE is 9. So that looks pretty cheap, but we'll talk more about that later. All right, so now let's talk about the moat. What gives this company a competitive advantage over their competition? So I think they have 2 different moats. They have a brand moat, they have a price moat. The reason why I think they have a brand moat, a lot of times you can actually look at specific numbers in their financials to see if people are coming back to the store to buy their product over and over again. And they have an extremely impressive free cash flow per share, which we'll talk to in a little bit. They also have a solid return on equity, return on invested capital. They have great margins for their industry. They have great gross profit margins, operating profit margins, and net profit margins, better than their competition. And I'm just pulling up some comparison numbers to kind of show you. So we have Sprouts here, we have Kroger here in the middle, and then we have Albertsons right here. And if we look at return on invested capital, 11% for Sprouts, so higher number the better. 11% for Sprouts this past quarter, only 3% for Kroger, and then 3% for Albertsons. If we look at debt, so long-term debt to capital, Sprouts is the best as well at 21%. So you want this to be a lower number, 21, 60% for Kroger, 70% for Albertsons. So the debt to capital is quite a bit lower than their competition as well. Another thing to look at is their margins. So gross profit margins, operating profit margins, and net profit margins are all better than their competition. So that is extremely, extremely impressive by Sprouts. All right, now let's talk about management. And Jack Sinclair, this is a guy I really like. So I did a video a few days ago on Intel, and I mentioned in that video that when I do research on management, on the CEO, a lot of times I don't have opinion either way if I like him or dislike him. I'm just looking for red flags. But I do like Jack Sinclair, just like I liked Patrick Gelsinger from Intel. And here's Jack. And the reason why I like him is that he's been in the grocery store chain or grocery store industry for more than 35 years. He's been with the company since June of 2019. From 2007 to 2015, Jack was the executive vice president of the U.S. grocery division of Walmart, where he led all aspects of Walmart grocery business, and it's more than 4,000 stores. He also spent 14 years at Safeway in London, so I think that's where he first got experience in the grocery store industry. And this is the guy that's really driving these new initiatives from marketing, smaller footprint. So he's trying to increase the amount of sales, but he's also trying to reduce the amount of SG&A and overhead by controlling marketing costs and also reducing the store footprint. So it's fantastic there. All right, so now let's take a look at financials, and this should say 7-year review. So we'll look at 7 years. And we're looking at different metrics. We have growth metrics, sales, earnings, free cash flow, book value per share. And then we're also going to take a look at some management effectiveness ratio as well too, from return on equity, return on invested capital, and then long-term debt payoff. And the first one I want to take a look at sales per share. And this is a company that is in a growing industry. They're a very fast growing company. I would expect this to be an upward trajectory trend on each of these. All right, so sales, we see that. So back in 2014, about $20 sales per share. And here in the last trailing 12 months, it's $55. So nice trajectory up. Earnings per share, we're also seeing upward trajectory up from less than $1 EPS back in 2014 to about 2.5 the last trailing 12 months. Free cash flow per share, we're also seeing this go up from about 0.36 to about 1.5 the last trailing 12 months. And I guess something I should point out too is if you look at 2020, it's an oddity year, right? If you look at earnings per share, you look at free cash flow per share, you can see these huge jumps. And the reason for that, with the whole Rona situation that happened last year, restaurants were closed and a lot of people were eating in. So a lot of these grocery store chains from Kroger, Sprouts, Albertsons saw a huge tick up in sales and earnings. But nonetheless, I would say, the trailing 12 months is fairly close what I would expect. Some of that, bleeding into, end of last year still in these numbers. We still see a nice upward trajectory. Now, if we look at book value per share, it is going up, but this was a concern to me when I first looked at it. So 4.5 book value per share back 2014 to a little over 8 today. And we'll talk about the annual percentage rates of growth here in a second. But so this is less than 10% growth per year, while the other metrics we looked at were well above 10%. So when I see a book value per share not growing nearly as fast as those other metrics, I personally like to dig in and figure out what's going on with those. So I went over to the balance sheet and looked at the last several years to see what was going on. And we see assets going up like this, right? So that's good. But we're seeing, liabilities going up quite a bit, but we're seeing equity kind of being a little flat. It's kind of it's not having the upward trajectory as fast as assets and liabilities. So that's also now concerning to me. Why are liabilities growing so much faster? So keep in mind that a balance sheet, how it works is assets equals liabilities plus owner's equity. So if book value per share is dropping, which is equity, that is telling me that liabilities is growing faster than equity itself. So I dug in further to figure out what was going on. And I found it by looking at the shares outstanding. So what happened is you look at 2014, they had about 152 million shares. And look at this, it's going down. It's going down to 114 million shares. So what's happening is actually this company has been very good about buying back their shares, and that's why it's decreasing equity. So what's happening is, since going back to the balance sheet, assets equals liabilities plus owner's equity, assets are dropping because the company is using cash to buy back shares. That's also decreasing equity. So assets are decreasing, equity is decreasing, but the net effect is actually increasing earnings per share. So this made me feel a lot better understanding what was going on with this company. Next up, let's take a look at ROIC and ROE. So that's return on invested capital, return on equity. I want to see at least a 10% or a year. So basically that's letting me know that for every dollar that's put into the company for shareholders' equity or for debt financing, so they can at least take 10% of $1 or 10 cents and generate net income. And Sprouts Farmers Market's well above 10%. So ROIC is right here. So they've been anywhere from 9% all the way up to about 21%. Return on equity, this has been anywhere from 17% to 39%. The reason why this one is so much higher is because of those share buybacks. So as they're buying back tons of shares, it's decreasing equity, and how this ratio works, it's net income over total shareholder equity. So it's really increasing this ROE. Next up, let's go take a look at debt. And here what I'm trying to do is I'm trying to look at free cash flow for the company and see if they can pay off their long-term debt within 3 years. And you can see their long-term debt has been going down. So back in 2014, they had 4.5 years worth of debt on their books, and right now it's at 1.4 year. So that is excellent. It's well below 3. The company right now has over $200 million of cash, and they have about $270 million of long-term debt. And as far as their competitors, we looked at before, long-term debt to capital, better shape than Kroger and Albertsons. All right, so now let's take a look at the 7 key metrics summary. And we're looking at those growth metrics again: sales, earnings, free cash flow, and book value per share. I want to see at least a 10% growth per year. So sales is 19% growth per year of the last 7 years. Earnings 23. Free cash flow per share 44%. Book value per share 9%. So sales, yes, it's growing more than 10% per year. Earnings, yes. Free cash flow, yes. Book value, no. But we looked into this, and the reason for that is they're buying back so many shares is decreasing equity. So even though this is a no, in my books, this is a yes. They're still in really good shape. Their return on equity, we want to see at least 10% average, and return on invested capital, at least a 10% average. So those are well over. So 24% for ROE, 18% for ROIC. So the company really manages their money really well, and 1.4 years to pay off their total long-term debt. So 6 yeses, 1 no, but the 1 no, we know that's still in really, really good shape. So that is fantastic. All right, so now we're going to talk about valuation, and we're going to look at first a PE trend and look at historical over the last several years, where the P is now versus where it has been. We're also going to look at acquires multiple, so that's enterprise value over EBIT or operating income. We're also going to look at 3 different valuation methods that I like to look at when I'm valuing companies: earnings per share, 10 cap, and my discounted free cash flow model. All right, so first off, let's look at the PE trend. And right now it's trading around a 9. This is the lowest the company has traded at in the last several years. So this looks like a really, really good indication the company looks cheap from a PE standpoint. In fact, if I look from this chart, I would say 20 looks like it's pretty average. And this company is supposed to be growing, at least from what analysts think that it should go. It's anywhere from 9 to 12%. And if we go back to that summary real quick that we looked at, we can see, at least from an earnings per share growth, 23% per year, 44% per year for free cash flow. So this company is growing at a really, really high rate. So they should carry a higher P, in my opinion, versus what the market is. And the average for the market usually is around a 15. So I think 20 is fair to say for this company. It's trading at a 10, which is extremely, extremely low. And so look at acquires multiple right now. Lower the better for this. So it's just similar to the PE. You want this to be lower, and we're seeing a drop. So they were all around a 35. Acquires multiple, now they're trading at a 10. In general, I would say acquires multiple, if it's under 5, that is a screaming deal. Being at a 10, in general doesn't necessarily say it's a screaming deal at all. But from a historical standpoint, acquires multiple is well below what they've traded at historically. So that is another potential good indication that this company could be at low value. All right, so now let's go take a look at my 3 valuation methods to come with intrinsic value for this company. So let's jump over to my spreadsheet real quick and we'll go through it. All right, first up is my intrinsic price calculation based on earnings per share. So I want to know what the earnings per share is over the last trailing 12 months and put it here. Right now it's around 2.3. I think that's a little high. So they're supposed to be coming in between 1.9 and about 2.1 this year. I think 2 is a very good number to use as far as earnings per share. So this is an estimate on my part. It's a reasonable number to use. Now, as far as growth rate goes, now, analysts think between 9 and 12% per year growth for this company over the next 5 years. We've looked at those numbers as far as, we'll go back to those real quick. This is what you guys saw in my presentation. So again, we're seeing 44% growth for free cash flow, 23% growth per year for earnings per share, and 19% growth for sales per share. So when I look at historical numbers, and the company's already said at least a 10% growth per year is what they are targeting, I think this company can really grow 12 to 15% per year. I really, really think that strongly. So I'm going to say the low end to be consistent is 12%, and we'll say analysts on average are around 10%. So I'm going to take an average of 10 and 12, and I'm going to say 11% as my growth rate. That's what I'm going to use for this one. All right, so we'll say 11% growth rate. out 10 years. So I think in 10 years, the future earnings per share for this company should be around $5.60. Future stock price should be around 124. And based on a 15% rate of return, I think the stock should be worth right now $30.88. So about $30 a share. So it's trading at $22 a share right now. So I think there's a 40% margin of safety right now on this company. So I think this company looks extremely good value compared to the rest of the market right now. So, all right, so now let's go take a look at my 10 cap valuation. And basically what I'm doing here is figuring out what total owner's earnings of the company is by figuring out what the free cash flow is, adding the tax provisions, getting total owner's earnings, dividing it by the total shares outstanding, get owner's earnings per share, multiplying it by a 10, and I get a buy price of $23 a share. So basically what I'm trying to do here is looking at the total worth of the company based on free cash flow and getting a value from that. I want the company to generate at least 10% free cash flow based on the valuation of the company. And we see that here. So the stock price is 22, 10 cap valuation is 23. So it's below that number, which is very good. Now let's go take a look at my discounted free cash flow model. And what we're doing here is doing growth rates out the next 10 years. So I have 12%, 1 to 3 years out, 10%, 4 to 6 years out, 8.5%, 7 to 10 years out. Discount rate about 15%. And based on that, I get about a $28 intrinsic share price. So we have $30 for earnings per share projected out, $28 for discounted free cash flow model, and about $23 for my 10 cap valuation. So generally when I look at these three valuations, I typically take the highest valuation, and that's what I'm going off of, what I think the company is worth. So now let's jump back to my presentation. We'll look at return on investment, what I expect this company to get based on today's stock price. All right, so now we're back on my presentation. And before I show you the return on investment, make it clear that these are my estimations. You should be doing your own valuation. You should be doing your own research. This is how I'm looking at this company. Each person has their own risk. They have their own understanding of companies and what they are willing to buy into and not buy into. So these are just what I think the company is worth and certainly not guarantee any kind of future performance. So let's take a look at my ROI table real quick. And as we can see, based on a 15% return on investment, it's $30 a share. If the company is around $20 a share, I would expect around 20% rate of return. So today it's trading at 22. So I would expect around 17 to 18% return on investment from this. Now in the future, if you're looking at this and the stock price is around $48 a share and those inputs that I made before on the growth is still accurate, I would expect around a 10% return per year. So that kind of gives you a good idea, at least how I'm looking at what I think the stock is worth and what return on investment I would get based on these stock prices. All right. So now let's talk about risk associated with this company. And the big one is competition. So they have obviously Whole Foods. They've been doing a lot of price cuts, which is owned by Amazon. They also have to deal with Kroger. They have to deal with Walmart. Both of those companies are getting more into the organic space. So certainly competition is going to be there for Sprouts. Distribution as well. There is some concern, I would say, as far as expansion into other states. So there's 23 states they're in right now. And since they have some really good relationships with regional and local farmers, with them being kind of in the southern, even Midwest region of the United States, does that carry over as they move farther north into the United States? They would have to build more relationships with farmers and that sort of thing. I think that's still possible, but that is certainly a risk. If they're not able to do that, that could potentially hold them back. All right, so here's my summary of my stock analysis on Sprouts, the good. So Jack Sinclair, I think, is a really good CEO. I think this was a very, very good choice coming into the company. He has a strong background being a Safeway for 14 years. He ran the Walmart grocery store chain for several years. So I think he has an excellent background. They have a really, really good solid balance sheet. Cash about $220 million, long-term debt $270 million. Cash flow statement, we saw a 7-year free cash flow per share growth of 44%. That is excellent. They're very shareholder minded. They announced a $300 million buyback program last year. This is a really solid valuation for this company based on current stock prices and my inputs. If they're correct, then it's about 17 to 18% return on investment based on today's stock price of $22. Now the bad, competition, lots of it out there. We talked about Amazon with Whole Foods. We talked about King Soopers. We've talked about Walmart. And then also potential, growth expansion issues or limitations as they have really good relationships with regional farmers. Is that going to be possible as they expand up north into the United States? So now we got to my stock grade for the company. And I give a thumbs down if it's 8% or less for ROI, thumb sideways 9 to 14%, thumbs up 15 to 19%. And if it's over 20% return on investment, it'll get 2 thumbs up. So based on that, I give it 1 thumbs up. I think it'll be around 17 to 18% per year. At least that's what I'm thinking will happen if the company can execute at a high level. So those are my thoughts on Sprouts. It's how I look at the company. This is a company that I personally own. Phil Town also owns this company and has talked about it on some of his podcasts. I know he is very, very bullish on this company as well. So thank you so much for watching. If you haven't subscribed to my channel, I encourage you to do so. If you haven't liked the video, get some value out of this, please like it. Helps out the channel a lot. I really appreciate it. Some future videos I'm planning to do. So one on AT&T, Micron, Foot Locker, Hingham Institute, Huntington Ingalls, and Ford. If you have any suggestions on stocks or companies for me to look into, please throw them down in the comment section below. I read every single one of those. And I just thank you guys so much for watching. I appreciate every single one of you guys. I'll catch you guys on the other side. Take care and God bless.